Hi friends, we shall take up a very unique problem which question was asked in CA final financial reporting problem number 12 and the RTP is related to September 25. Let me repeat, we are doing problem number 12 RTP of FAR CA final September 2025. We have in this particular discussion problem number 12 titled as a problem from Ind AS 105. Actually, this is a consolidation problem which we can take it up from Ind AS 110. Now let us just proceed into that, and where I have just given that particular question in one particular slide. Now let's just go through, and in Sreeram coaching point we were trying it out in a simpler way, the consolidation. So the problem is on Ind AS 110 consolidated financial statement, and it is not on 105. In a way, you can even try through business combination Ind AS 103. So this is a problem involving application of 103 and 110 and not 105. Okay, see that of course the source for which we are making it clear that it is representing consolidated financial statement. Now let's go through what we have in this particular problem to be understood, and the same has got to be taken care while we take up the examination, hoping that this question is appearing in September 2025. So this is the problem that we have. This problem is running into 3 pages. I have taken the printout. It runs to 3 different pages. So I've just brought that into one particular PPT. Now let's go through and find out exactly as what has happened there. A Limited as a wholly owned subsidiary B Limited. So A is parent and B is wholly owned subsidiary WOS. A sells subsidiary B Limited to C, a listed entity, for shares in C Limited and ends up owning 75% of C Limited shares. Let me repeat. A is the parent company and B is the wholly owned subsidiary company, and they have sold the shares held in B Limited to a listed company, that being C. If it were to be for cash, then there would be no connection between A Limited and B Limited after the sale. Whereas in this particular case, A Limited took shares from a listed company C, and because of getting the purchase consideration in shares, that is in stock, it had become 75% owner of C Limited. So all of you closely follow. So A Limited is the parent company and C Limited has become 75% subsidiary. Now C Limited is owning 100% in B Limited, and thereby by applying 75% on 100, it comes to 75% in B. So now we understand A is the parent company, B is subsidiary company on an indirect basis because it is a subsidiary of the subsidiary. From 100% it got reduced to 75%, and C Limited is 75% subsidiary. So in consolidated financial statement that we have got to prepare, though the question was given with computation of gain on sale and goodwill on acquisition of C Limited, that is what they have given. But we can tell for sure that in this consolidated financial statement that we are expected to prepare, A Limited is a parent company and B Limited is 75% indirect, and C Limited is direct subsidiary company. So from what it was 100% wholly owned subsidiary, now it had become 75% indirect subsidiary. So therefore the control is continuing to be there in B Limited before and after, and what it was 0 non-controlling interest in B Limited, now you have 25% non-controlling interest in B Limited. So therefore when A Limited or when the parent company continue to hold the control, when there is a change in the percentage of holding, we have got to consider this as equity transaction. That is, it is a transaction between the shareholders. Now it is as good as A Limited selling it to minority interest to the extent of 25%. They continue to hold the same parent subsidiary relationship. Maybe the percentage would have undergone the change. Now let's go through the second paragraph. So this will communicate the numbers there. The net assets of B Limited prior to the disposal of B Limited is 10 lakhs, fair value being 13 lakhs, and goodwill previously capitalized and not impaired is 6 lakhs. The carrying value of B Limited in A's books being 15 lakhs. See, now you understand in the books of A Limited, you have 15 lakhs shown, and this is the investment that they were making, and we understand that the net assets of B is 10 lakhs, as you just find the net assets being 10 lakhs here. We are trying to corroborate, we wanted to connect with the numbers, and the fair value of that being 13 lakhs, and goodwill previously capitalized and not impaired is 6 lakhs. How that 6 lakhs is coming up, that we will make as a work. Please just wait for some more moment. Then at the date A Limited acquired B Limited, B Limited's profit and loss account reserve was rupees 4 lakhs. So we understand today we have 5 lakhs, 4 lakhs being the pre-acquisition reserves and surplus, which we normally call it out as a capital profit. The one that arose after the acquisition, that being 1 lakh, we will take it up for consolidated profit and loss account. That is what it is all about in this particular case. The position prior to the transaction were as follows. So we have the goodwill which had just come up for in the computation. As how this would have come up is a very simple matter only. So when 15 lakhs is the purchase consideration, against which 100% capital of 5 lakhs and the pre-acquisition reserve to the extent of 4 lakhs. So this will occupy 9 lakhs against the purchase price of 15 lakhs, resulting in excessive payment, that being goodwill to the extent of 6 lakhs, and that is coming up in the form of CFS that they have prepared, and the other 1 lakh which resulted after the acquisition is added to the parent's profit and loss account, and thereby it is shown at 96 lakhs of rupees. So now share capital of the parent continue to be there, and the share capital of the subsidiary company got eliminated. 4 lakhs of subsidiary company got eliminated, 1 lakh is added, and rest of the item are simply taken into the consolidation. So here one important thing that you understand is that the fair value of 13 lakhs, they have not incorporated in the consolidation. So I am just trying to communicate what they have just done. See, whether it is right or wrong, that is a different story that we will take it up separately. So after this, let's proceed to the next part of the slide. The net assets of C Limited prior to the acquisition of B Limited being 380,000, that you have it here, and the fair value of that is 5 lakhs. Then C Limited then issued shares worth 17 lakh and 50,000, and what it was 15 lakhs previously, now it is investment in C Limited 17 lakh and 50,000, which is the fair value of the consideration given for the acquisition of 100% of B Limited. So please understand that C Limited, upon taking over 100% of B Limited plus its own net assets, all that put together, they have brought a value of 17 lakhs and 50,000, and 17 lakhs and 50,000 is how it is getting discharged. 6 lakhs in the form of nominal value, and 1150 in the form of additional paid in capital. This particular problem seeming to be picked up from US GAAP, so where they call security premium in the name called additional paid in capital, or APIC. So APIC means additional paid in capital, which is representing the security premium. The balance sheets of these three companies directly after the issue of shares were as follows. So they have given you A Limited, previously it was 10 million, and the 10 million is appearing there, and net assets of B Limited and 1 million, that being 10 lakhs appearing, and 3 lakh and 80,000 is the new piece of information. So the other share capital of 2 lakhs continuing to be there, and this 97 lakhs and 50,000, how it had come is that 95 lakhs they have taken up. Please look into the investments, which is at 15 lakhs. Now it is at 17 lakhs and 50,000. So the other 2 lakh and 50,000 increase they have added to the retained earnings. So maybe a gain is what they would have taken up and taken that to their retained earnings, which is nothing but your profit and loss account. And share capital of B is continuing to be at 5 lakhs, and the retained earnings is nothing but 1 lakh and 4 lakh together being 5 lakhs of rupees. So you do not find any change in B Limited. Now C Limited's information, we have to take it up as retained earnings of 1 lakh and 80,000, which got printed one line below. So 21 lakhs and 30,000 being the balance sheet total of C Limited. Now let's go through what they communicated here. The parent A Limited has an interest in B Limited that cost 15 lakhs and in effect swapped this for interest in C Limited. In its separate financial statement, A Limited states its investment in C Limited group at the fair value of the consideration given at 17 lakhs and 50,000. So how much is that? 17 lakhs and 50,000. Say why I am reading is that, say I wanted to just be sure that what is shown there is 17 lakh and 50,000. The non-controlling interest is determined with reference to the proportionate share of the acquired C Limited net identifiable assets. Okay. Then required or compute gain or loss on effective disposal of B Limited. Then number 2, compute the goodwill on acquisition of C Limited. Then note, C Limited is not required to prepare consolidated financial statement. C is the last subsidiary company there. A, B and C. C is not expected to prepare any consolidated financial statement and ignore the possibility that the transaction will be classified as a reverse acquisition of C Limited by B Limited. So ignore that chance and we are expected to answer to these two questions. I mean, compute the gain or the loss on effective disposal and compute the goodwill. Say, how do we crack this problem? See, now let's just go through the consolidation as how it had just come. So this consolidation, of course, I have already done it in the second slide. So as how that 600 had just come. So now let us just understand as on the date of acquisition, these are the numbers that we are having, and this 100 is the revenue profit, and 1500 is the investment value, and the net worth is 900. Excessively paid that 600 that comes into consolidation. So this is what you have, and how this 9600 had just come, and how in consolidation it will be reported. So this sort of preparation is normally seen in the case of US GAAP sort of problems. So in Indian scenario, we used to have it in I would just say working notes only. But let's just see as how it can be taken up. Equity of the parent and the subsidiaries equity is automatically get eliminated, and this 200,000 is taken up there. So retained earnings of 9500, and out of 500, 400 is taken up for goodwill computation. The other 100 is added, 9600 you will be taking up. So that being the total, net assets of these two companies are expected to be reported, and this goodwill of 600 has got to be taken up, and thereby it is 11,600, and investments will automatically get eliminated, and you will be finding the total of liability side matching with that of the asset side. Now we will focus on two important things in our discussion. One is the gain or loss on effective disposal of B Limited, and then we will take up on to goodwill on acquisition of C Limited. So how is that this gain has got to be taken up? See, now let us just proceed. I hope that all of you are having the question in your hand when this solution is drawn. So let me just take it up. Item number 1. Please understand, the first question is that of gain or loss on effective disposal. Now what it was and what it is. So now let us just take up that. So it is all about A, in which B Limited held 100%, and now A in B on indirect form it is 75%. So therefore NCI of B is the creation that they have made. So NCI of B will be 25 percentage into 1600, that comes to 400. Correct? NCI of B is the sale that they have made, because B they were holding. So to the extent of 25 percentage they have sold it, and they got NCI of C. So that being 25 percentage into 1750. Remember in the discussion that we were making, C Limited's net asset value is 1750. 25 percentage of that comes to 437.5. So 437.5, and in that process, what you just get is a gain of 37.5. So let me repeat. Previously, it was 100% minority in 100% wholly owned subsidiary company and with no NCI. And because of this arrangement, it had become 75% subsidiary, resulting in NCI created to the extent of 25%. So this is what we have sold now. Because of from 100% to 75%, we have sold only to the extent of 25%, and their cost is 400, and we have brought NCA of C to the extent of 437.5, resulting in a gain of 37.5. I hope that this point is very clear on addressing the first question of computing gain or loss on effective disposal of B Limited. So prima facie it looks like you bought C Limited to the extent of 75% and sold 100% of B Limited. Please understand, by selling B Limited to the extent of 100%, we are only taking up 75% back. How come? Because C Limited will hold 100% in B and A Limited is holding 75% in C, and thereby applying 75% on 100, it comes to 75%. Thereby, prior to this arrangement, A Limited was holding 100% in B, now A Limited is holding 75% in B, and thereby we have sold to the extent of 25% effectively, and that works out to a cost that being 400. And in the process, we have also created 25% in C, that we have applied as 25% on the net asset value of C on 1750, and because of this, we have taken up 37.5 more, and that is what we have to take it up as gain. So now the computation, we will be focusing on the goodwill computation. How this goodwill computation that we will take up? It is a very simple computation only that we will be taking up. So net assets of B is 1750. Net assets of B is 1750. So how come they have mentioned in the problem that it is 1750? Because why at all C Limited has got to be 1750? Because the worth of B is 1750. So net assets of B is 1750 and the net assets of C is 500. That also they have mentioned. So what it was 380 in the balance sheet, they have mentioned that the fair value of that is 500. So any seller for that matter, he will tell the fair value of the asset that he is disposing. He will not be telling the historical cost. So 1750 and 500 are the total value, that being 2250. So in a way that A is holding in B 75% and A is holding in C 75%. So this being 100% both in B and C, by applying 75% on this, how much it comes to? So now let us just take up 2250 multiplied by 75%, it comes to 1687.5. So this being the true net worth, how much is that we have taken up as purchase consideration, that being investments, that comes to 1750, and thereby the excess payment that we have made is 62.5. So goodwill in the process of C Limited paying to A Limited being 1750. How is that? They have said 600 in the form of equity capital and 1150 in the form of additional paid in capital. Do you remember that? So we have got two important questions answered. One is the gain 37.5, the other one goodwill of 62.5. See, I would like to put it out in the form of or in the scheme of journal entry, so that it becomes easier for you to prepare the consolidated financial statement. So when we have just done that, we will be doing it in single journal entry, the entire thing. So let me debit goodwill for 62.5. Then the net assets of these two companies we are expected to take up. The net assets of B is 1750. Then net assets of C comes to 500. So these are the net assets we are going to incorporate in the consolidated financial statement. I have three debits: goodwill 62.5, debit for net assets of B 1750, then net assets of C 500, and we will offer credit to NCI of B and NCI of C, that being 400 and 125. Remember that 400 is computed 25% on 1600, and 125 is applied on 500, and offer credit to investments. I don't have the space there. I am noting down credit investment 1750. From where I am just getting this 1750? 1750 is appearing in the balance sheet of A Limited after the purchases from C. Then the last one, credit gain on acquisition, which is 37.5. Now you take the calculator. In one stroke we are debiting 3 items, we are crediting 4 items. So the numbers that we take up are 62.5 plus 1750, then 500, then all that put together, that comes to 2312.5, the total of debits. Now let us take up the credits. 400 plus 125 plus 1750 plus 37.5. So all that comes to the same 2312.5. The total of debit is equal to total of credits. So now in the last slide, I wanted to prepare a consolidated financial statement, though in the main question it was not asked. So in a way we have completed at this stage within 22 minutes the entire question, but I would like to go an extra yard by preparing consolidated financial statement. Now I have one particular slide in which I would like to take up this consolidation. So as how it was prepared, A and B for consolidation. Now we will be having A, B, C, elimination and CFS. Now let us just take up the first one, that being equity. When you have equity to the extent of 2000, in the case of B it is 500, and in the case of C, that being 800, we are expected to eliminate the capitals of these two subsidiary company, and 1300 we are expected to show with negative sign, and thereby retain only the equity stock of the parent in the consolidated financial statement. Very simple one. Next one, retain earnings. In this particular case, I would like to take up the capital profit and revenue profit separately. How much is the capital profit that we would like to take up in the case of B? That going to be 400, that existed at the time of controlling acquisition. Remember that. Then you have 180 as against C. Remember in our slide that 180 was shown one line below. Remember that. So you would be eliminating this 580. So the capital profit will not appear in the CFS. So the next one, revenue profit. In the case of A, it was 9500, and in the case of B, it was 100, and nothing of that particular sort here. And we are expected to take up some amount of deduction that we are expected to adjust in elimination. So how much is that we are expected to take up? That being the gain. Remember the gain we have taken up in the computation. We have passed a journal entry. What journal entry we have passed? So the journal entry that we have passed is debit goodwill. See here we have the space. Debit goodwill 62.5. Then debit net assets of B and C as 1750 and 500. Credit NCI of B, which is 400, NCI of C 125, and the investment which has got to be credited 1750 credit investment, because it is no longer an investment in consolidation, and credit has to be given to gain on sale, that being how much is that? 37.5. This 37.5 is what we will be putting it out, and this is going to be plus figure. So minus figure, like that you have a negative, that is plus figure, and the total number that we are going to take up will be 9637.5. Am I right? See, after passing this journal entry, you understand as why it is plus. Then next item, additional paid in capital. Additional paid in capital, which is nothing but, what is that? Security premium, which being dash dash 1150, which appeared in C Limited, which has got to be eliminated for goodwill computation 1150, and you do not have any additional paid in capital in the consolidated financial statement. The next one is that, remember that when it was 1500 initially, when new investment was taken up 1750, that 250 they have taken up against the retained earnings. Remember that in the balance sheet immediately after those sale of B and acquisition of B, that 250 they have included along with 9500, and this 250 has got to be eliminated minus 250, and we are going to put a dash there. So with NCI, which we never had in separate financial statement, A, B and C, where we will be adding how much? 400 plus 125 plus 525, you end up with 525. Ultimately, in the consolidated financial statement on the liability side, you will have only three items. So that being equity, consolidated retained earnings and non-controlling interest. Only this many that you are having, we will affect the total a little later. The space is not that much available, so therefore we are focusing on this particular issue, dash dash dash. So the goodwill which has got to be taken up 600, which was very much there earlier, that will continue to be there, and this goodwill of 62.5, 662.5 is an addition 662.5, that will be taken in consolidated financial statement. Then comes your net assets which are appearing at 10,000 there for A Limited, 1000 in the case of B, and 380 in the case of C, and plus 120, because in all our computation we have taken up 500 as a value. On 500 only we have applied 25% to get NCA at 125. So we have got to add 120, and thereby the net assets value has got to be taken up at let me just check up. So it is 10,000 plus 1000 plus 380 plus 120. So all that comes to 11,500. This is the net asset value that we will take into consideration. Then comes investments. Investments appearing in A Limited at 1150, not 1150, 1750. 1750 dash, once again 1750 in the books of C Limited, because that much is the money that they have paid in the form of capital and security premium. Both the items we are expected to eliminate 3500 there, and nil value is what we got to report. Now let us take the calculator and check up for the total of assets and liabilities. Now let us take up for A, and we will be noting down at the top, and let us just do that. It is 2000 plus 9500 plus 250, all that comes to 11750. Now let us just understand that it is 11750. Is that right? Now let us take up in the case of B Limited, the total of these comes to 1000, and this also is taken up by 1000. So now let us take up for C Limited. It is 800 plus 180 plus 1150, that comes to 2130. So the same 2130 is appearing here. 2130 is the total that you are getting. Now in elimination column, that is adjustment column, The figures, some of them are negative, some of them are positive. Now let's just take up all these together. 1300 negative, then 580 negative, then 37.5 positive, then 1150 negative, then 250 negative, then 525 positive. So all that comes to 2717.5 negative. Now on the asset side also, the elimination process should give us the same number. Now let's go through that. It is 662 positive plus 122 positive, then minus 3500, which gives you the same 2717.5 negative. So every column of the consolidation working, A, B, C and elimination process also getting the same number. Now let's just take up for CFS this way. 2000 plus 9637.5 plus 525, all that comes to 12162.5. Now let us just pick it up from the asset side, which is also 12162.5. See, my only request is that don't panic by looking into the RTP suggested answer. So follow the lectures that we have given here, and we have made a very simple attempt, and definitely I would just consider that it will be very easy for you to follow, and this particular problem is covered under 103 and 110 and certainly not coming under 105. Is that clear? All the very best for your examination, and I would like to hear a very good news of clearing the examination of September 2025 in FR and other papers. So in fact, I wish you all the very best and get very high marks in your examination and become chartered accountant soon. Thank you.